We're looking at two options that are roughly on the same price stock, same expiration, same strike price. What was the difference in price between the two, Des?
One premium was 64 cents and the other one was $1.37, almost double.
There's this factor called implied volatility. Now, this should be a huge eye-opening moment for a lot of new options traders.
Welcome to Options Trading Essentials, a video series dedicated to teaching you the ins and outs of options trading. In this episode, we're going further down the rabbit hole of options pricing, and we're going to introduce the concept of implied volatility.
Implied volatility is one of the most important factors to understand when trading options, but also it's one of the hardest concepts to grasp for the first-time options traders. So we'll take our time going through this together.
Yep, which is why you'll see us dedicate a number of future episodes to implied volatility. But for now, we're going to start simple and introduce some concepts and slowly work our way to the more advanced stuff.
In this video, we'll define the general concept of volatility, what it is, what it means, and how it impacts the price of options. And later on, Kendall and Obi will show us how to find the implied volatility of an option on the Robinhood app. But first, let's define the general concept known as volatility.
A stock that is unstable is said to be volatile. The more volatile a stock is, the more likely it is to move far and fast from its current price. Think of it like this. When you go to an amusement park, there are all types of roller coasters. The beginner rides stay slow and flat, then there are some that go a little faster with a few turns and hills, and finally, there are just the crazy ones with twirls, loops, and giant drops. You can think of stocks the same way. Some stocks don't move much, others move a lot. The ones that do are considered to be more volatile. What does this have to do with options? Well, a lot actually. So much of an options price is based on what a stock might do in the future. The options market in many ways is trying to predict how volatile a stock will be by a certain date. We measure this prediction with a number called implied volatility. We use the word implied because we're implying the potential future movement of the stock based on the options price. Let's get to Obi to explain this a little bit more.
Okay, as we start breaking down the concept of volatility, we kind of have to treat it like an onion. We have to peel it one layer at a time. It's complex, gets very detailed, but in this episode, we're just gonna focus on the concept of volatility. So let's look at a couple examples. I'm gonna draw a price chart, and you can see over time it's slowly kind of moving up and then down. It's kind of making its way, it's drifting higher in price, but it's not doing anything erratic. Kind of slow and steady here, right? And then it reaches this point out in time. Now let's look at an example of a different stock. Instead, this one is definitely more erratic. It's going up, it's going down, and it's doing this in very large amounts, really fast. In this example, this first stock we would consider this a low volatility stock. Now, volatility doesn't necessarily mean a stock doesn't go up and down. It's really by what magnitude does it go up and down. Meanwhile, the second stock, which we would consider high volatility, even though both of these stocks reached the same price at the same time, this stock took a much different path to get there. It was constantly going up and down by wide amounts. And so as traders, when we talk about volatility, what we're really talking about is how far does something go and how fast does it get there? And sometimes we refer to this as the speed of the market. All right, let's go a little bit further down the rabbit hole. Now, as traders and investors, we generally look at volatility in one of two buckets: what has happened in the past and what might happen in the future. So let's break this concept down. Starting with what has happened in the past, we generally call this historical volatility. And we call it historical because it's what has happened in the past. So if we were looking at, say, a stock price for XYZ, we can look and observe what the stock has done, and through some, and I'm just gonna keep this simple today, through some math, we can actually calculate the historical volatility, which we call HV, as a percentage. And don't worry what this percentage means right now. Just know that volatility is displayed as an annualized percentage. And through some math, by looking at past stock movement, we can assign an actual number to the historical volatility of a stock. Now, what about future volatility? Well, if we had a crystal ball, we would know what that is, but unfortunately we don't. And so the best guess we can use as traders and investors is to look at the options price and derive an implied volatility from what the prices of the options are telling us. Let's break that concept down a little bit more. So here we have today, I'm just gonna call this now, and our guess is where will the stock be trading at a future date? Let's just say for this example, we're gonna look ahead 60 days until some options expiration. So here we have the stock of the price now. This is the volatility it has experienced in the past, but what do we think the stock is gonna do over the next 60 days? Well, we don't know, but we can look at the options prices for clues. So a stock that the market is guessing might be a little less volatile over the next 60 days, well, we can look at the options price tag, and we can derive from that it might be a lower volatility. And for example, that number might be displayed once again as a percentage, but maybe the options are telling us that IV is 25%. Once again, don't worry what that number means. We're going to explain that in future episodes. But from a visual standpoint, what the options might be implying is that the stock might land within this range over the next 60 days. And therefore, the option prices along all of those strike prices will be reflected accordingly based on the market's best guess at where they think this stock might land by expiration. Now, of course, guesses are guesses, predictions are predictions. Some are right, some are wrong. And so, of course, even if an option is implying a tighter range for the stock, of course, we know a stock can go outside of that range, but it's the market's best guess at what might happen most of the time. Now, what about a high implied volatility stock? Well, in that case, the options might be implying a wider range of potential outcomes for the stock 60 days from now. And so that range we might call high implied volatility. And that number will be higher, maybe something like 50%. But remember, the stock price as of today is sitting right in the middle of that range. And so we're trying to guess where might the stock land 60 days from now. And if it's a tight, narrow range, we would consider that potentially low implied volatility. If we think the stock's going to do something crazy over the next 60 days, the options might reflect that best estimate. And of course, there's a lot of reasons why stocks move, and options traders are always trying to price in those potential outcomes.
Option prices are always changing. Why? Well, in large part, it's because stock prices move up and down as time goes by. But the real undercurrent for an options price is its implied volatility. To illustrate this, think about some reasons why a stock might move in the future. There might be an upcoming earnings announcement or a new product launch. Maybe the company is going through legal issues, or possibly there's a rumored merger or acquisition. Whatever the reason, the options market is always pricing in their best guess at what might happen in the future. This is implied volatility. Usually, when implied volatility increases, the prices of options will rise as well. On the other hand, if implied volatility decreases, the prices of options usually fall, all other factors remaining constant.
You've heard a lot about implied volatility today, and there is so much to unpack here. So, Kendall, Obi, take it away.
All right, we got a lot in store for everyone, so follow along with us. You guys remember a few episodes we talked about the four main factors that impact an options price. There's stock price, which is always changing, strike price of the option, which doesn't change, days to expiration, which is always going by a day at a time, and then implied volatility, which we've started to explain in this episode. We're gonna isolate three of those four factors and look at the difference that implied volatility has on an options price, looking at two different stocks with two different implied volatilities. So Denver, help us out I want you to take us to the option chain for Verizon, symbol VZ.
All right, perfect. What expiration were we looking at?
Let's look at the September 10th expiration, which is about 3 weeks to expiration. All right, so Kendall, I want you to look at the 56 call for us, right? Look at the stock price and then show us how we can see the implied volatility of this option.
Yeah, let's get into it. So right now, Verizon's trading at about $55.90. So let's take a look at that 56 call. It's kind of right at the money there. So Desiree, why don't you jot down the prices here just so we can refer back to them. So we have that 56 Verizon call. The premium right now is at 64 cents.
Okay.
So let's go ahead and tap on that premium and it should pop you up to the stats page for that contract. So let's solely look at the implied volatility percentage. So for this particular one, the implied volatility is at 12.2%. So why don't you go ahead and jot down the implied volatility for this contract?
Okay, beautiful. So let's now, Denver, we're gonna look at another stock that's right around the same price. We're gonna look at the same September 10th expiration and the same 56 call, but we're gonna look at a stock that has a slightly higher implied volatility. So take us to the option chain for ExxonMobil, symbol XOM.
September 10th?
Yep.
Okay. All right. And then we want that 56 call. Okay.
Now, we've got a stock that's only about 10, 20 cents lower than what we just looked at. So Exxon and Verizon, for all intents and purposes, basically are around the same price. We are looking at the same September 10th expiration and the same $56 strike. Kendall, why don't you reveal it for us?
Yeah, so that 56 call for Exxon is, that premium's trading at $1.37. So significantly higher than what we just saw with Verizon. So go ahead and tap on that premium again. Let's pull up the stats page for this particular contract. Let's look at that implied volatility. And you notice it is changing a bit, but we've got it at 26.8% right now. So quite a big shift there, and you can see it reflected in the premium.
Yeah.
And this just brings home the idea. Implied volatility has a major impact on the price of the option. What was the difference in price between the two, Des?
One premium was 64 cents and the other one was $1.37, almost double or double.
This should be a huge eye-opening moment for a lot of new options traders, that there's this factor called implied volatility. Now, let's just sort of demystify. The word implied volatility, as we talked about earlier in the episode, it's what the options prices are implying for the potential future move of the stock, okay? But it doesn't mean that that will hold true. Now, we did some stuff with balloons in the last episode. Kind of want to bring this concept back home. So if you still got your balloons, bring them out.
All right.
And we're going to do the same thing. Remember in the last episode, we talked about extrinsic value and time value of the option, right? Well, implied volatility directly impacts that time value, right? Time value is not just this thing associated with days to expiration. And so if implied volatility is greater, there's more time value. If implied volatility is lower, there's less time value. So let's do the same thing. You're gonna blow up the balloon a little bit bigger. So here's our four options: nearer term expiration, further out, way out, right? This is sort of the traditional, there's more time value because there's more time in this option. But if we pause all factors, right? And if this particular stock, as Kendall mentioned, you know, we look at stocks, maybe there's a news event, maybe there's uncertainty in the market. So now the market is pricing in more volatility because we don't know if the stock's gonna go up or down. We just think it's gonna become more volatile. All of these options are gonna increase in value just by buyers coming in to buy those options. So let's just blow up our balloons a little bit more. So now we got the same options. We haven't moved the clock forward on time, right? We haven't changed the stock price. But these options have gotten more expensive because we've priced in more implied volatility. So if you were the buyer of these options just a few minutes ago and volatility increased, your option is now worth more, all other factors remaining equal.
I see.
All right? And so you can see the value of options can go up or down simply because buyers and sellers are changing the price of those options. And that's what we call implied volatility.
So is demand another thing that affects implied volatility?
Think of it right now as supply and demand of options. And that percentage that you wrote down, 12%, 27%, we're gonna explain what that number means and how it's calculated later. But just think of it, if more people are coming in to buy options for whatever reason, the value of those options are, all other factors held equal, going to increase. And then on the flip side, if everyone comes in and starts selling their options, the value of those options are gonna start decreasing.
I see.
makes sense.
Okay, it makes so much more sense now. I felt like the premium number was so random before, but I really see how it kind of plays in or is affected by supply and demand. Got it. Time value, implied volatility.
They're two sides of the same coin. Sometimes that coin is small, sometimes it's big, but it's actually always moving around. And so as options traders, we don't always have to trade the price of the stock. We can create strategies that hopefully will profit if time goes by and maybe implied volatility goes down. Or on the flip side, if we think there's going to be an expansion of implied volatility, like some uncertainty is going to enter the market, we could potentially buy options, and that implied volatility spike would help us as well because it would increase the price of the options, all other factors held equal.
I think about IV, and now it's kind of changed my perspective. Like I'm thinking, how can IV drive my trading?
Yeah, I used to think like time was of the essence, which it is, but now there's implied volatility to consider.
Yeah. On the next, options trading essentials.
It's time to revisit the topic of options expiration.
The processes in place are a little bit different at every brokerage firm.
When my options expired, I have to be proactive.
The last thing you want to do as an options trader is take a vacation on expiration.
Thanks for watching the video. If you enjoyed this episode, smash that like button and leave a comment. And don't forget to subscribe to the channel to get alerted when new episodes become available. Remember, options involve risk and are not suitable for all investors. Before trading, check out the link below in the description.